Santoli, let's start with you. I think the word you used in your column today for this market is ambiguous.
It is ambiguous in terms of knowing whether what we've been dealing with since August, this compression in bond yields, the fears about growth, is really just kind of a stutter step in the expansion, or if it's in fact the leading edge of something worse. And I do think the market's been contending with that. Today, in the last week, it's kind of interesting. I think the collective thought was, look, maybe markets overshot in August in the short term on this recession trade, on this idea that you have to only buy defensive stocks and all the rest of it. So today, you had a market overall treading water in the indexes, massive moves underneath the surface. My favorite is software stocks down 1.6%, energy stocks up 1.9%. Money coming out of very, very crowded, popular momentum names going into things that have been left behind. That mean reversion can go on for a while, I think, even in the absence of much change in the fundamental picture, as long as bond yields continue lifting.
I get your point, Mike, as well about the individual sector performance. Banks, as we've already mentioned, were strong. Yeah. But when you look at the move in the yield curve today, which was risk on, both in terms of moving higher and steeper, would you have expected the S&P 500 to track higher as well in terms of the broad moves we've seen of late in those correlations?
It would have been not surprising, I guess, to see the S&P as a whole go up higher. But I do think the fact that this has been a multi-day move out of the big growth winners. And I think that's just a little bit too much for the index, for the rest of the index to lift. By the way, that's an issue. For anybody saying there should be a rotation into value and cyclical, makes all the sense in the world. Doesn't mean the overall index is going to move very much just because of how everything's weighted in there.
Mona, what's your take on this? You agree?
Yeah, it's interesting to see some of the cyclicals that had been lagging, like we talked about. Financials and energy really were not popular trades coming into the quarter and really coming into the year. It had been tech on one hand and the defensive on the others, like REITs, staples, parts of, industrials. But what we are seeing today, and perhaps over the last week or so, is the laggards are really taking hold here. Whether or not, like Mike referenced, this is a longer-term rotation or something just temporary as positioning is going into the fourth quarter of the year remains to be seen. I think it'll be driven by the fundamentals. Do we get more progress on trade? Do we get a base on GDP growth and global growth generally? And do we see some of, the consumer resilience continue?
So you positioned for more rotation or not?
I think right now we continue to maintain our barbell approach. One hand of that barbell continues to be some of those defensive sectors. We think that makes sense here. It's really been a nice comfort as we were going through this last quarter. But the other hand of that barbell, we still like some of those tech sectors. Now, perhaps it's not just the cloud, cybersecurity, software. A broader tech portfolio that can do well longer term, I think, makes sense.
And Stephanie, we were talking about in the last hour is the fact how you feel about the cyclicals and rotation into those. But I guess looking at the market more broadly here, do you think earnings need to keep coming down? The expectations are still too high, or do you think they've bottomed out here? And that based on at least some of the data we've seen so far, that maybe the second half of the year is going to be a little bit stronger than had been anticipated.
And it goes back to what has worked and where the earnings have remained strong, like the defensives, right? They have actually been pretty good, a little better than expected. Can that keep up? I don't know. But I do know the cyclicals, the industrials, the financials. Look at the relief rally we saw today. Numbers have been coming down for the last several weeks for these two sectors, and energy especially. So I really think that we're going to continue to see this rotation, mean reversion. Watch the dollar. That's going to be very, very important in my book, too. But I think based on where we are and where earnings are at, the cyclicals continue to run.